Yeah, that's a pretty good summary. I started my career as a lawyer in the late 70s, but before I went to law school, I got a graduate degree in international economics. So I have that, that macroeconomic background, if you will, even before law. And then after getting out of law school, I started my career as international tax counsel for Citibank. So that's about as broad a platform as you can have. And then along the way, switched into securities and derivatives law, worked for an investment bank, major dealer in U.S. government securities. That gave me a pretty good background in federal finance. And then switched to the hedge fund world and was there from start to finish at long-term capital management. Made a few headlines in 1998, and I was the principal negotiator of that rescue by, people say I was rescued by the Federal Reserve. That's not exactly right. The Federal Reserve did convene a meeting of the banks to organize the rescue, but said to the banks, you have to do this. They were sitting in the boardroom at the Fed, kind of hard to say no, but they adjourned over to Merrill Lynch's boardroom a few blocks away on Liberty Street, and we took it from there. And it was one of those deals, 5 days, no sleep, nobody's shaving. At first the jackets come off, then the ties come off, then the shirts are unbuttoned, and everyone's got a beard. Nobody slept, but we got it done, brought it in for a soft landing. After that, around an electronic stock exchange for a while, but was tapped by the CIA to help them with counter-terrorist finance after 9/11, and worked for them for 10 years. That's what we did. We invented a new branch of intelligence called MarkInt, for market intelligence, basically getting actionable intelligence from capital markets information, which had never been done before. There's the INT stands for intelligence, so HUMINT is human intelligence, SIGINT is signals intelligence. We invented MarkInt, or market intelligence. That took on a life of its own. But along the way, was just got literally a cold call from a top literary agent. She heard an interview I did on NPR's Planet Money. She's an NPR fan, and introduced herself and said, how would you like to write a book? And so I said, I hadn't really thought about it, but let's talk. And we had lunch, hit it off. And then that led to book projects. And now, 7 books, and 10 years later, here we are. So you can either say I had an eclectic career, or I didn't what I wanted to be when I grew up, but I've done a little bit of everything from banking, capital markets, hedge funds, national security, intelligence, work with the Defense Department, and written a bunch of books.
Well, it's great to have you here. The first book, which came out 2011, was Currency Wars, The Making of the Next Global Crisis. And you certainly touch on a lot of currency dynamics, which are certainly prescient to what's going on today in the latest book, The New Great Depression here. When did you start writing this book? It's just come out in the past week, but it just seems so relevant and timely. I mean, you must have had some pretty fast turnaround on this thing, right?
We did. I got the call from my agent, my publisher, late April, and of course, then we were in the thick of the first wave of infections and fatalities, sadly, and quarantine and lockdown and all that. And the stock market had just dropped 30%, over 30% from February 24th to March 23rd. And so they said, we really want to book on this. It's really important. There's going to be huge interest in this. And can we do this? And I said, sure. And our original target date was July 15th. We were trying to come out on July 15th. And that's what we worked towards. So I said, so basically, given the target length and the outline, I was going to write it in about 40 days, 45 days. If you do 2,000 words a day, you can get there, but that's a lot of writing. So I said to my wife, well, there's good news, bad news. The bad news is for the next 30 days, I'm going to be the most antisocial person you ever met. The good news is we'll have a book behind us and we'll get that done. And that's pretty much what we did. I worked really hard straight through and kind of writing in the morning and reading at night, and almost like researching, doing the research at night, and then waking up the next morning and writing up the research and other observations. And it was all happening very quickly. I mean, obviously the disease was expanding, the economy was collapsing, but the amount of academic literature on the subject was, we're getting 10 papers a day coming from all over the place, and that was good, but it was an enormous amount. But But when I first discussed it with my publisher, they said, well, Jim, we think you're great on the economy and capital markets and central banking and all that's really important. And that's what we want you to write about. But keep away from the epidemiology and the immunology because you're not a scientist, you're not a doctor. And I said, hold on, that's like asking someone to write about property damage in New Orleans in 2005 and not mention Hurricane Katrina. I said, you can't do that. You obviously, the pandemic is the catalyst or the cause of the depression, and you can't understand one without understanding the other. So I said, I'm going to do both. I teased her a little bit. I said, well, I do have 2 degrees from Johns Hopkins, so I'm not intimidated by natural science. I'm not a doctor, of course, but I'm comfortable in the field. And when I approached it, when I started doing the research, so by the way, Alex, this is the first book that deals with both the pandemic and what I call the new Great Depression or the economy. There will be lots of books written on the pandemic. Doctors have already written some. They're out there. There'll be books written on the economic crash and what's going on. Although it's a funny thing, economists actually don't write that many books. There are some, other than textbooks. Textbooks can be huge money makers, kind of boring, but there are a few economists who write books. Paul Krugman does, and Barry Eichengreen, and a few others. But generally, economists prefer to write papers, journal articles, monographs, and things because they're usually wrong and they're changing it. So you write a paper and you're wrong. Well, just write another paper. Writing a book, you go out on a limb a little bit because if it's going to have any kind of shelf life, you have to lean forward and do a little forecasting. And I have ways of doing that are better than what Wall Street and Washington do. But you're still you're out on the limb a little bit. But I'm comfortable and I've done that before. But on the medical side of it, I read over 100 peer-reviewed journal articles. Obviously, top publications like The Lancet and the New England Journal of Medicine and others, but others that were top tier, maybe less well known, more specialized. But these papers were coming out left and right, and other evidence was coming out. And when I started doing the research, I said, well, this is going to be straightforward. There's a bunch of conspiracy theories and fringe theories and just wacky, speculation over here. And there's a lot of good science by reputable clinicians and PhDs over here. And just kind of discard this and focus on this. And that's what I did. But what I discovered, it was easy to discard the junk. But when I got into what I'll call real science, I discovered quickly that the scientists don't agree with each other. I can show you papers that say, you're a fool to go out without a mask. Masks are the key to this whole thing. Everybody mask up. That's the way we get a handle on the pandemic. I can show you other papers by equally qualified people, PhDs in virology and epidemiology, who say, no, masks don't work. The virus is too small. It goes through the weave. They're improperly constructed. We don't wear them correctly. And they don't do much good. It's kind of virtue signaling. And so, but my point is, without even taking sides in that, just as a writer, and I did present both views, and all that information is in the endnotes. The book has over 200 endnotes, and they're all fairly technical. So I tell people, if you don't like something I said, don't argue with me. Go to the footnotes or the endnotes and argue with the scientists. But I tried to, when there were divisions like that, I tried to represent both sides fairly. But I usually do come down on one side or the other based on my own view of the evidence. So that made it more challenging. And then you also had this whole, where did the virus come from? I have a chapter on that. Well, there's the wet market theory, which I thought last spring was a lie, basically Chinese propaganda. That's even more apparent today. You have the laboratory theory that it came from a laboratory, particularly the Wuhan Institute of Virology. Good evidence that was the case last spring. That's much stronger today. A ton of stuff has come in literally in the last couple of weeks, bearing that out. But that's how I came out in the book. I said it did come from the laboratory, but that's another area where, again, I can find top scientists with both points of view. I did learn in reading these scientific journal articles, there's always an abstract, that the authors, their affiliations, the abstract, and then the main paper. I would go right to the last page and look at who paid them, because they're, modern practices. You disclose your sources of research grant. If I saw you were paid by the Chinese, I discounted you about 50%. I might have included it, but I certainly took that into account.
We're seeing something globally we've never seen before. and it is the best single indicator of a recession. The last time we saw anything like this was 2007, just ahead of the 2008 financial catastrophe. So the stock market's saying it's all good. Goldilocks, soft landing. Fed's going to get the memo. They're going to cut rates, the pivot and buy stocks. The bond market is saying, no, this is bad and it's going to get worse, and it's actually too late for the Fed to do anything about it. But what happens is, as you get closer to the actual thing you're worried about, the inversion gets nearer and nearer. Now it is literally a month away, or less interest rates are a lagging indicator. Everyone's like, well, how could interest rates going up if we're in a recession? The answer is, as you get close to recession, who figures it out first? Well, the Fed figures it out last. They're usually the last to know. Wall Street is second last to know. The people who figure it out first are actual business people, entrepreneurs, restaurant owners, dry cleaners, taxi drivers, or even medium-sized businesses. They see it. A lot of business people are living in the real world, in real time. They know what's happening now, and the stock market tends to figure it out later. But as far as banking and credit is concerned, what happens is if you're a business person and you see business heading down, fewer customers, whatever, you go out and borrow while you can. You're like, hey, this is a really bad recession coming. If I got lines of credit, I'm going to use them up. Now, I don't want my bank changing the terms. I don't want material average change clauses kicking in and said, I'm going to borrow everything I can. And that creates a demand for funds. And interest rates go up. And then the recession hits. And the bankers go, what's going on? Credit losses start going up. And then they just turn off the spigots and they raise standards. They stop doing loss. And then interest rates will start to come down. But interest rates peak after the recession has already begun. So stock market is telling us, Goldilocks, bond market's telling us, here comes Hurricane Mitch, or whatever. And then there's what I call the reality. What I see is kind of a hybrid. The Fed's doing what they're doing, right or wrong. Okay, they're doing what they're doing. The market has their own interpretation. I agree with the market, certainly the bond market, that the Fed is probably over-tightened. They're going to keep going for reasons I explained. That means they're going to make it worse. They're going to make the recession even worse. We've seen this movie before. This is exactly what happened in 2018. I don't know. Attention spans seem to be short these days, but it was not long ago. Go back and look at a chart, any stock index chart, from October 1st, 2018 to December 24, 2018. The stock market dropped 20%. I mean, it's like 19.9 or something on the Dow, so maybe not technically a bear market, but yeah, what's the difference? It dropped 20%, culminating in the Christmas Eve massacre, December 24th, 2018, when I think NASDAQ dropped like 3% in one day. Now here's the point. The Fed was tightening into that collapse. The Fed tightened on December 16th, 2018, only like 8 days before the Christmas Eve massacre. And after most of the 20% collapse had already happened, they tightened one last time. So what it shows you is that when the Fed's on a mission, they actually don't care about the stock market. This whole Bernanke put and Greenspan put and all that, that's not how it works. They don't care that much about the stock market level. Here's what they do care about. They care about disorderly markets, and that's the keyword. Stocks are going down, but it's kind of 0.5% a day, 1% a day, trending down. Lower highs, lower lows trending down. The Fed doesn't care about that. They're not going to bail out the stock market. They do care if it's disorderly. When was it disorderly? Well, March 2020, at the worst part of the pandemic, it dropped like 30% in like 2 or 3 weeks. The fall of 2008. I mean, it was like somebody opened a trap door. The Fed does care about that because that kind of disorderly behavior can feed on itself and end up in a 1929 type scenario. So the Fed will get the memo, as I put it, stop raising rates and begin cuts when the markets are disorderly, but not just because they're going down. Now, here's what the Fed is missing, or maybe everybody's missing. When you hear these layoff announcements, people are like, well, if they're laying off, why isn't the unemployment rate going up? Unemployment lags the business cycle. Unemployment is a lagging indicator. When you're an employer entrepreneur and you're in any kind of not as many customers walking in the door, you'll do everything you can to avoid laying people off. Be late on the rent. You'll turn down the lights, find a cheaper laundry, whatever it takes. And then by the time you get around to firing people, you run out of options. I've done everything I can. Now my business is in jeopardy. I have to fire some people. And then combine that with what I just said about severance and rolling terminations, etc. It's a lagging indicator. We know enough right now to know that number is going up this spring, but that's not inconsistent with the fact that we're already in a recession. It's exactly what you would expect. that unemployment is a lagging indicator. Now, having said that, what else is the Fed missing? Well, wages are up 5% on annualized basis, 5.2% on an annualized basis. I'm like, yeah, and inflation is 7% or 6%. So your real wage just went down 1 or 2 points because when the Bureau of Labor Statistics reports those wage numbers, those are nominal numbers. I'm not saying they're fake, but you have to know that they're nominal. And you have to subtract inflation to find out what's happening to real wages. And the answer is real wages have been going down for a couple of years because it runs around 5% annualized, give or take. Sounds like 5% raise. What do you want? Well, yeah, but with 8, 9% inflation or even 6% inflation, your real wage is going down. So that's not a robust number at all. By the way, the Fed wants to make it worse. The Fed agrees that those wage gains are too high. But my point is, in real terms, they're actually going down, but the Fed wants them to go down more. That would be one way to put it. If you get inflation down and wages are constant, then the real wage goes up relative to where it was before. But if you're unemployed, you have no wage. So that's another issue. Now, what the Fed is missing, and it's a long list, but there's something called the labor force participation rate. Now, the labor force participation rate, you just take the number of people working divided by the total working age population. That's all you do. It's not sophisticated. And that number today is around 61.2, give or take percent. But as recently as 2000, that number was over 70% and has come down ever since. And it dropped like a stone during 2020. During the pandemic, lockdown came back a little bit, but not much. The reason it got, first of all, it's never 100%. It shouldn't be. There are legitimate reasons to be working age population, not working. You're a homemaker. You're a student. There's a bunch of perfectly good reasons. So it's never 100%, not even close. But 70 is pretty high and 60 is pretty low, and the trend has been down. So that leaves relative to kind of a normalized number. That leaves about 8 to 10 million people between the ages of 25 and 54 who are not in the workforce. There's a big untapped labor pool. But if you took that group and threw it into the unemployment numbers the way the Bureau of Labor Statistics calculates it, unemployment would be about 9%. And that's the depression level of unemployment.
Notably in 1980 and 1981, regrettably, analysts anticipate that the recession will surpass expectations, with the bottom potentially falling lower than predicted, perhaps a 30% to 50% decline in the S&P, around 22,100. While we had a brief respite between 2020 and 2023, the situation is worsening in 2023 due to the concurrent financial crisis. The financial crisis is currently brewing, causing widespread panic. If it materializes, the impact will be severe, marking a dark day for America and the world. It's important to note that each financial crisis carries its unique level of impact, ranging from substantial to less significant losses. Predicting the scale and duration of a crisis is challenging, as evidenced by the subprime mortgage crisis from 2007 to 2008, which coincided with a recession, resulting in a disastrous outcome. The expansion of mortgage credit triggered this crisis, enabling widespread borrowing and mortgage acquisition. This mistake led to the collapse of the U.S. housing market, causing many to lose their homes, savings, and jobs. The repercussions extended globally given America's pivotal role in world trade. Discussions on recession, inflation, and deflation aside, one aspect yet to be addressed, referenced earlier, is the possibility of a global liquidity crisis. In 1998, despite the absence of a recession, the financial world faced a near collapse. Such crises can coincide with recessions, resulting in severe consequences. A notable instance is the subprime mortgage crisis from 2007 to 2008. There's speculation that 2023 might witness a collision between a financial crisis and recession, resembling the 2007-2008 scenario. Financial experts, including Jim Rickards, highlight signs indicating such a development. These signs include a diminishing world trade, daily declines in industrial output coupled with rising unemployment, and historically high interest rates for the past 15 years aimed at combating inflation but failing to curb inflated prices. If there are lingering doubts about the recession and financial crisis, examining the recent state of American banks provides clarity. In just a month, 5 major banks have faced setbacks, such as bankruptcy, FDIC takeovers, and collapses. The combined losses of credit and stockholders from these events surpass $200 billion, sending a clear signal of systemic issues. Efforts by the FDIC to reassure the public include unconventional measures, such as guaranteeing depositors sums exceeding $200 billion for Silicon Valley Bank and Signature Bank. These unprecedented actions, while seemingly noble, are predicted by Jim Rickards to deplete the FDIC insurance fund, ultimately affecting consumers. Moreover, the Federal Reserve's decision to extend more loans to member banks through the Bank Term Funding Program, BTFP, is causing significant turmoil in the U.S. banking system. These moves have intensified public anxiety, particularly among depositors. Concerns arise regarding whether these actions aim to implement new policies or if they are motivated by the interests of a few affected entities. The parallels to the 2008 crisis, where the FDIC guaranteed all bank deposits, echo in current events. As the government faces unrealized losses exceeding $700 billion in U.S. bank portfolios, the continued cash provision to depositors raises concerns about the sustainability of the banking system. The looming question is whether the crisis is truly over, or if the panic is just beginning. Drawing parallels with the 2008 financial crisis, which started a year and 6 months before reaching a critical stage, the current crisis, only a month old, has already led to the downfall of 5 banks. Addressing the broader economic situation, the FDIC's guaranteeing of all depositors and the Federal Reserve's offer of additional loans through BTFP signify pervasive issues. The Fed's guaranteeing of all bank deposits surpassing the $250,000 insurance limit echoes actions taken in 2008 to avert bank runs. However, such measures may strain the FDIC insurance fund, with potential consequences for consumers. As the government grapples with increasing unrealized losses in U.S. bank portfolios, the fear is that continuous cash provision to depositors will hasten the collapse of the banking system. Despite attempts to reassure the public, it remains uncertain whether the crisis is truly averted. The interconnectedness of the banking system and the broader economy becomes evident, reflecting a situation that extends beyond individual instances. The Fed's unusual actions, coupled with the FDIC's extraordinary measures, intensify the prevalent challenges. Considering the gravity of the situation, the looming question is, what should one do? How does one respond to the panic and secure oneself against the impending crisis? While the inevitable cannot be avoided, taking proactive steps to preserve wealth becomes crucial. According to Jim Rickards, the first step is acquiring gold.
Get down 20% in 3 months, getting close to crashing it. So what happens next? First week of January, Powell comes out, okay, we're not going to raise interest rates anymore. We're going to be patient. They use all these code words. We're going to be patient. Then he starts cutting rates. Then he starts QE, I forget if it was 8 or 9, whatever, lost track of QE. He starts QE 8, let's say. And then that takes you into 2020, and here comes the pandemic, and rates go down to 0, and the balance sheet goes to $7 trillion. They were back where they were in May of 2013. Except worse, because now the balance sheet was even bigger than it was then. A complete failure. So who thinks they're going to be more successful this time? They're doing the same thing. It's going to happen faster this time because the market saw that whole 7-year fiasco from May to 2013 to May 2020, a 7-year round trip failure. The same thing's going to happen, but it's going to happen faster this time because the market knows that the Fed doesn't know what they're doing. So the Fed's tightening into weakness. One of two things is going to happen, and it's not clear which, but it's going to be one or the other. They're going to keep tightening and keep tightening and keep tightening, try to get a handle on inflation and crash the stock market. Or they're going to lose their nerve, back off on the tightening, and then inflation is just going to rip, which will also crash the stock market. So take your pick, but it's going to be one or the other. But this idea of a soft landing is nonsense. The 2021 thesis was that, inflation grew. Part of it was base effects because, the way the government calculates inflation, it's monthly data compared to the year before. So it's year over year, monthly, then annualized. And so one could easily explain inflation in April, May, June 2021 because you were comparing it to 2020, which was the worst recession since 1946. But the base effects would run off in September, October, November. but the inflation persisted, even though the base effects were gone. So now it's like, okay, this is real inflation. It's coming from somewhere else. It was coming from the supply chain, which the Fed can't do anything about either, because the Fed doesn't drill for oil, they don't build pipelines, and they don't grow wheat. The Fed can't do anything about any of those things. And that's where the war and the sanctions and the continuation of COVID played a role. So, I say you can have your own views, but you can't have your own data. The data is clear. The inflation is here.
The renowned economist Jim Rickards continued her speech as follows. The supply chains are deteriorating, but these disruptions in the supply chain did not originate with the conflict. They didn't even commence with the pandemic. They initiated with the trade war led by Trump in 2018. I discovered an excellent book on this topic, authored by Luan Larocco. What's intriguing about her book is that she completed it in late 2019, serving almost as a control experiment. It predates the pandemic. It's convenient to attribute the disruption in the supply chain to the pandemic, which indeed played a role. And the conflict also had its impact. However, we have a meticulous examination of the supply chain's condition before either event, and the conclusion is, it was chaotic. It was chaotic back then due to tariffs on China and China redirecting soybean purchase orders from the United States to Brazil. That may seem straightforward because Brazil cultivates soybeans. Well, guess what? You have to transport the ships to Brazilian ports. You have to reorganize all the logistical lanes. That was already happening. The pandemic exacerbated it, and now the conflict exacerbates it even more. Yes, the world is fragmenting. We're disengaging. Globalization is concluding. There will be a new iteration of it. It's not the termination of world trade, but you might witness perhaps the Five Eyes, UK, US, Canada, Australia, New Zealand, and allies in Western Europe forming a new trading bloc while excluding China and Russia. It will resemble somewhat the Cold War. I discussed this with Paul B. However, in the 70s, something similar occurred. It commenced with cost-push inflation. It was the Arab oil embargo in 1973 after the Israel-Arab War. Then the Arabs imposed the embargo on us, quadrupling the price of oil from $3 a barrel to $12 a barrel. It might sound inexpensive, but that's a 300% increase. Subsequently, we experienced a severe stock market crash and recession in 1974, the most severe since the Great Depression at that time. We've encountered more severe ones since, but back then it was the worst recession since the Great Depression. Following that, the Fed intervened and Nixon abandoned the gold standard. Nixon implemented an accommodating monetary policy in '72, a bit earlier for his re-election effort, etc. So, here comes inflation, but along the way, and then there was another oil embargo, actually an Iranian oil embargo in 1979 after the Ayatollah took over. So there were dual oil shocks. It was a supply-driven cost-push inflation. However, it transformed into demand pull. It evolved into a demand-side scenario that I lived through. I was a young, up-and-coming lawyer at Citibank, a senior officer living in New York City. That was a time when if you desired anything new, furniture, TV set, vacation, anything, you rushed out. You dropped everything, rushed out, and did it because the price was escalating so rapidly. This is instructive in two ways. Firstly, it illustrates that the Fed is consistently behind the curve. It shows that these issues can persist much longer than anticipated. But more crucially, because I believe things will happen more swiftly now, it demonstrates inflation shifting from cost push to demand pull, transitioning from a supply-side matter to a psychological shift on the consumer side. Volcker managed to suppress it, but at a substantial cost. Unemployment reached approximately 11%. He elevated interest rates to 20%. How does that feel? Mortgage holders, student loan holders, and others? 20%. We're talking about 40% on credit cards in that era. People tend to forget, well, doesn't inflation mean you have high growth or whatever? At least low unemployment. No, we had stagflation. We had inflation and high unemployment. There were 3 recessions between 1974 and 1982. We experienced 3 in 1974, 1980, and 1981, which persisted until 1982. By the way, people lost confidence in the dollar in the late 70s. Jimmy Carter's Treasury issued what they call Carter bonds. The U.S. Treasury issued debt in Swiss francs. Now it was Treasury.
Slowing industrial output, slowing retail sales, and importantly, for investors, a very sharp decline in inflation. So this is one of the kind of mystifying points about the U.S. stock market. I mean, it seems straightforward to me, but the market has their own dynamic. They're saying, well, If the Fed raises rates the way I've described and they cause a recession, the Fed's going to have to cut rates. That's called the pivot, the Fed pivot, and lower rates are good for tech stocks, so buy stocks. But think about that for a second. What if inflation comes down faster than the Fed thinks? And I think it may, by the way, I'll return to that. What if inflation comes down really fast and they get to the target rate sooner than they think? Does that mean they might have to cut? Well, it might, but what's good about that for stocks? I mean, if that happens, no one ever says, why did that happen? They just say, well, inflation may come down, interest rates may come down, so buy stocks. It's like, well, inflation may come down, interest rates may come down, but if it does, it's because we're in a very severe recession, exactly what I'm forecasting. And so if that's the case, stocks are going to plunge, 30, 40, 50%. So don't root for lower rates, or if you're forecasting lower rates, understand what that means. It doesn't mean the Fed chickened out. It doesn't mean life is wonderful and you should buy tech stocks. It means that we're in the very severe recession that I described, and I think we will end up there. And therefore, stocks are going to plunge. So, be careful what you wish for, as they say. My forecast is, yeah, they are going to raise rates. They're going to over-tighten. They're going to cause a very severe recession. And when they do, they may pivot at that time, but it won't be for good reasons. It'll be for very bad reasons, meaning we're in a recession and stocks have plunged. So don't buy into the Wall Street chatter as far as that's concerned, because as I say, the Fed's going to over tighten.
Now, why isn't the Federal Reserve aware of this? Well, because they never are. Because they have the poorest forecasting record of any institution I can think of. Their entire history since 1913 is one mistake after another, and this will just be the latest in the long series. So, just to kind of recap, the Fed is on a trajectory. We know precisely what it is because they informed us. All you have to do is listen to them and believe them. They're going to increase rates, let high rates do their work, and observe the inflation come down, and maybe in 2024 decrease rates. What I anticipate is they are going to raise rates for the next couple of meetings exactly as I've outlined, but they're going to over-tighten. The signs of recession are already present. The Fed's not looking at them. I'll come back to what they are, by the way. And we'll be in a very severe recession for a lot of reasons. And that's going to mean a plunge in stock prices. So if the Fed cuts rates, don't cheer too loudly, because it'll be in a world where severe recession, higher unemployment, and crashing stock prices are the norm. I'd like to conclude on, I can't call it a joyful note, but a global liquidity crisis. Now, I talked about a global recession, and people go, well, isn't that like a liquidity crisis? No, a recession or a depression is very different than a liquidity crisis or a financial panic. They're two different things. They can and do happen separately. In 2008, we had both. In 2008, the recession or depression and a financial panic converged, so they can happen together, but they don't have to. They can happen individually. What we're in for visually looks like a global financial crisis and a global recession at the same time, coming sooner than later. Now, why do I say that? There's a global dollar shortage. People go, wait a second. The Fed printed $9 trillion, which they did in 2020. It's come down since then, but they did print that much money. How could there be a global dollar shortage? What people don't understand is that behind the curtain off-balance sheet, this is off-balance sheet. You've got to go read the footnotes and understand what you're reading. There are $1 quadrillion of derivatives. And for those not familiar with quadrillion, 1 quadrillion is 1,000 trillion. So, I just said the Fed printed $9 trillion. Maybe it's down to 7 trillion, but you have $1 quadrillion of derivatives, and they have to be supported with collateral. Not 100%, not even 10%. I mean 1% or 2% is enough. But when you're in a liquidity crisis, banks are extremely choosy about which collateral they'll accept to support this $1 quadrillion inverted pyramid of derivatives. And right now what they're saying, because this evolves, it gets worse. It doesn't happen overnight. It can become acute overnight, but it happens over the course of a year or longer. What we see, the banks are saying, I don't want corporate bonds as collateral. I don't want your mortgages as collateral. I don't even want 10-year treasuries as collateral. The only collateral I want are short-term U.S. Treasury bills. Treasury bills have a maximum maturity of 1 year, 360 days, but there can be 4-week bills, 8-week bills, 6-month bills, etc. That's the best form of collateral. It's the most liquid, easily traded, low volatility, easy to repledge, is by far the best form of collateral. That's all the banks want right now. But if you're a foreign bank, you need dollars to buy the dollar-based collateral. If you want treasury bills that are denominated in dollars, you need dollars to buy the bills. That's why the US dollar is so strong. People go, wait a second, the US has a multi-trillion-dollar annual budget deficit, a massive trade deficit, 132% debt to GDP ratio, $31 trillion in debt. You're going into a recession. How can the dollar be so strong? The answer is everything I just said has nothing to do with the demand for dollars in international foreign exchange markets.
Countries like Switzerland, Germany, Austria, China, and various Asian nations have maintained a strong affinity for gold. In contrast to the United States, where gold investment is often overshadowed by more traditional financial instruments, these countries have a deep-rooted appreciation for the precious metal. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
They are accelerating their purchases, and I do think it's a sign of things to come. Now, when you talk about retail, so everyday investors, Americans, I love America, but I've kind of given up on Americans and gold. They just there are people who have positions, and your hedge funds will have paper gold, they'll do gold futures, but the everyday American has been 40 years at this point of being miseducated on the topic of gold. So they're not very much into gold. You go around the world, you get very different results. Switzerland, Germany, Austria, they love gold. Of course, China, Asian countries. I think Australians have a much better sense than Americans do. So there are the buyers of gold. But you say, well, okay, well, who are the big buyers of gold? The answer is the central banks. Now, right there, that should tell you something. So these are the most powerful, most plugged in, most heavily monetary institutions in the world. And they're the ones buying gold. Now, they would have you believe that gold's not money, gold serves no purpose. It's the first ones to say, John Maynard Keynes said it was a barbarous relic, which he never said, by the way. He said something, he used the phrase barbarous relic in reference to the gold exchange standard of the 1920s, which was a hybrid gold foreign currency standard, but the foreign currency is not gold. So he said that's a barbarous relic, but he never said that about gold himself. And actually, toward the end of his life, he favored, at Bretton Woods, he favored a global currency called the Backward, backed by gold. And it's not guesswork. There are papers he published at the time, and that was rejected by the United States, which kind of ran the show, partly because not to get too down in the weeds, but our Undersecretary of the Treasury, who was our representative at Bretton Woods, was a Stalinist agent. He was a communist. This didn't come out until the 90s, after the fall of the Soviet Union, when a lot of classified information was released, KGB files, etc. But it was revealed and fully documented in a book by Ben Style called Battle of Bretton Woods, that he was a communist agent. So what was he trying to do by insisting that, by running Keynes's idea off the road, insisting that the US dollar be the anchor? He was trying to destroy the British Empire, which he did, because he knew that there were far more claims on the Bank of England than they had gold, and that would be inherently unstable, and that would derail sterling as one of the global reserve currencies and undermine the British Empire, which it did. So that's a little bit of a backstory, but it goes to the point that Keynes was an advocate for gold at different times in his career and at the end of his career, and that when the central banks are buying, that should tell you something. Now, I've said for years, I've always pointed to Russia and China. Russia has almost quadrupled their gold reserves in the last 12 years, starting in 2009 through 2021. They've almost quadrupled, from about 600 tons to about 2,400 tons. China, the same, not quite, from about 600 tons to about just under 2,000 tons that they report. But they're non-transparent. They have a lot more gold than that stashed in something called SAFE, the State Administration on Foreign Exchange, which is a secretive Chinese sovereign wealth fund run by an ex-PIMCO guy, by the way. He knows what he's doing. And they're non-transparent. So the People's Bank of China is kind of transparent. SAFE is non-transparent.
The crux of Jim Rickards' argument lies in the behavior of central banks, the most powerful and influential monetary institutions globally. Rickards highlights that central banks, including those in Russia and China, have been steadily increasing their gold reserves over the past decade. Russia, for instance, nearly quadrupled its gold holdings from 2009 to 2021, while China, although less transparent, has also significantly boosted its gold reserves. What is particularly telling about central banks' interest in gold is that they are the custodians of monetary policy and are deeply ingrained in the global financial system. Rickards argues that their preference for gold should not be dismissed as mere nostalgia for a bygone era when gold was the primary backing for currencies. Instead, it reflects a strategic decision to safeguard their wealth and financial stability in an ever-evolving economic landscape. Jim Rickards dispels the notion that gold is an outdated relic, as some critics argue. He points out that even renowned economist John Maynard Keynes, often cited as a critic of the gold standard, had different perspectives on gold throughout his career. Keynes indeed criticized the gold exchange standard of the 1920s, but he later advocated for a global currency backed by gold.
So every 6-7 years, what you'll see is the People's Bank of China will announce, oh, we've increased our gold reserves by 400 tons or 500 tons or whatever, as the case may be. And well, it sounded like they went out the night before and bought 600 tons. Good luck trying that. You can't do it. Well, what it means is that SAFE took some of the hidden gold that they had been acquiring slowly and in an accounting entry moved it over to the People's Bank of China, and boom, there's 500 tons overnight. But of course, they had it all along, and they still do. So they probably have more. So Russia and China are big acquirers, again, tripling and quadrupling their gold reserves. But now we're seeing it in a lot of other countries. The Philippines, Vietnam, Mexico, Iran is a major buyer, but non-transparent. Turkey has drastically increased its gold reserves. These are major countries, and they're adding. So I look at that, and there's very good data from the IMF and the World Gold Council, so you can find this information. But the one that was just like not doing anything was Japan. They had about 600 tons. But they had 600 tons for 30 years. I went back and looked at all the old data. It was like 30, never, that was boring. Who cares about Japan, 600 tons? And then just about, at this point, about 6 months ago, so late last summer, they bumped it by, I believe it was 50 tons, perhaps more. I gotta look at the exact number, but it was over 50 tons overnight. It just went from, 600 tons to 650 tons, just like that. Well, here's what you know. Same thing I said about Russia. You can't buy 50 tons overnight, or you couldn't even do it in a month. I mean, the dealers would be working the order, it would be disruptive to the market. It would leave a lot of fingerprints, put it that way. But what it tells you is two things. Number one, Japan had the gold all along. They had it in some sidecar or side account or Ministry of Finance hidden account, as the case may be. And they chose to move it over to their reserve position, which they can do. That's an accounting entry, but they had to have had the gold all along, because you can't buy that much that fast. So then that begs the question: well, why all of a sudden? Why now, after decades of holding your gold level constant, do you all of a sudden step up in a big way? A lot of possible answers to that. One, China's making noises about invading Taiwan. Well, if you're going to invade Taiwan, why not invade Japan while you're at it? It's just another chain of islands as far as the Chinese are concerned.
Rickards emphasizes that the misinterpretation of Keynes' views on gold has perpetuated the misunderstanding of the precious metal's role in the modern financial system. In doing so, he underscores that gold has historically played a vital role in global monetary systems, and its significance should not be underestimated. As central banks continue to accumulate gold reserves, the question arises: why? Jim Rickards suggests several reasons. First, gold serves as a hedge against the US dollar's potential devaluation due to inflation or loss of confidence in central bank currencies. Second, it can act as a buffer in times of economic crisis and geopolitical uncertainties. Rickards also speculates that the actions of central banks like Japan, which recently increased its gold reserves significantly, could be driven by concerns over the reliability of the United States as a geopolitical ally. The aftermath of the U.S. withdrawal from Afghanistan has left many nations questioning their dependence on U.S. protection, leading some, like Japan, to fortify their financial and military positions.
And after this happened right around the time, maybe shortly after the U.S. debacle in Afghanistan, which was, the worst foreign policy, military disgrace, humiliation in U.S. history that I can remember. I don't know how far you'd have to go back to find a worse turn of events. And that there it was. Well, all of a sudden, allies all over the world, Israel, Japan, Taiwan, they're questioning the United States. Like, hey, we're under your nuclear umbrella. You stand by us through thick or thin. Here you leave Americans behind enemy lines. So perhaps, now this is speculation, but perhaps Japan sees the threat to Taiwan, feels they may be in the sights of the Chinese, feels the United States may not be as reliable as one had thought, and says, well, we now have to step up a little bit financially, militarily, et cetera. And they're doing that. But that aside, that's a little geopolitical speculation, but that aside, the gold is real. They put it on the books. So the biggest buyers of gold in the world are the central banks. By the way, from 1970 to 2010, central banks were net sellers. Now, some bought and some sold, but on net, they were net sellers. We had Brown's bottom in 1999 when the UK sold half their gold at the lowest price in about 60 years. they literally hit the bottom at about $200 an ounce, give or take. But since 2010, central banks in the aggregate have been net buyers, and that buying is accelerating. So what does that tell you? It tells you that the most knowledgeable players in the world are adding gold to their reserves because they consider that a prudent hedge to the US dollar, if you have US dollar inflation, or to collapse of confidence in central bank currencies generally, or they're just saying, hey, we're part of the club. By the way, here's a good trivia question for you, Shay. If you're in a bar and with a lot of brainy economists around, ask them, bet them a drink on this. Ask them what percentage of U.S. reserves are in gold. The answer in China is about 2%. Russia's about 20%. You know what the percentage is for the United States?
It's got to be 0.5%.
75%.
75%.
75%. The U.S. does not rely on euros and Aussie dollars and Canadian dollars for its reserve position, a little bit, but 75% of U.S. reserves are in gold. So don't let any central banker, don't let Jay Powell or Janet Yellen or any of these others tell you that gold's not a monetary asset. We have the largest gold stash in the world, and 75% of our reserves are in gold. So that's the U.S. As they say, watch what they do, not what they say. I would say that the Fed's monetary policy will fail or is failing, and fiscal policy will fail, is in the process of failing, even if gold didn't exist. If you didn't have gold as a multi-millennial monetary standard, even if gold wasn't there as a reference point, which of course it is, but these policies are failing anyway, and there are a lot of reasons for that. Whenever I hear fiscal stimulus, I say, well, no, the Fed can print money all day long and the Congress can spend money all day long, but don't call it stimulus. It's not going to have any stimulative effect. We're way past the Keynesian multiplier, which is now below 1, meaning if you borrow $1 and spend $1, you don't even get $1's worth of GDP. You get some numbers, 70, 80 cents. Forget about the multiplier. It's actually now, a divide or something that reduces GDP. Well, you don't get the GDP for the borrowing. And same thing with monetary policy, because unlike Milton Friedman, the monetarists, the neo-Keynesians, the Austrians, and everyone else, money printing has nothing to do with inflation. And they seem to, well, I don't know if they ever knew it, so I can't say they forgot it. So all the money printing and all the deficit spending will not stimulate the economy. And that's true anyway, but gold is signaling that. Look, all markets try to be forward-leaning. Some do it more successfully than others, more accurately than others, but they try. I would say that, people say, the stock market is an efficient discounting mechanism for future events, for what they see in the future. And they look into the future. Here's the forecast. They pick out a discount factor. They present value it and say, here's where stocks should be today, based on where things are going to be, 6 months or a year from now. And that's what they do sort of mathematically and analytically, except they're always wrong about the forecast. You got to get the forecast right if the discounting process is going to mean anything. So markets go through the process but they always get the future wrong. They're not very good at predictive analytics. So this creates what I call the gap between the perception and the reality. Reality always wins, but not right away. Sometimes it takes a while. Gold, on the other hand, has very high predictive analytic value, number one. Number two, it's more forward-looking. So gold's kind of telling you where things are going to be maybe a year to 18 months from now instead of 6 months from now. And so, so gold is signaling that monetary and fiscal policy will fail and something else will be tried. And that ultimately will result in a much higher price for gold. So gold's just saying, well, let's do it now. Look, I've got gold at $15,000 an ounce by 2025. If I'm wrong about that, it'll be sooner and higher. But well, I consider that a conservative forecast. And we can maybe take a few minutes to go into the analytics behind that. As I've said before, you've heard me say, I don't just throw numbers out there to get attention. I don't really care. I do care about getting the analysis right. There's a number of different techniques, and what's interesting is they all point in the same direction. So it's got to go to 3,000 before it gets to 15,000. It's got to go to 5,000 before it gets to 15,000. So that's my kind of long range forecast. But it could go down tomorrow, and I'm like, I don't get depressed when it goes down. I don't get euphoric when it goes up. I know where it's going in the long run. That's the important thing if you're trying to preserve wealth and make money. Nothing wrong with making money. I'm all for it. But sometimes preserving wealth, risk aversion is a higher priority than just making a lot of money in the short run. But either way, gold will serve that purpose and preserve wealth over that time period. Could it go down tomorrow? I guess, yeah. But all the vectors are pointing up very strongly. I'll give you a concrete example. There are three things that drive the price of gold fundamentally. One that you've already mentioned, which is real interest rates. The lower the real interest rate, the higher the price of gold. Number two, supply and demand. You learn it in your first 3 days in economics, but it still works. And then number three is geopolitical risk. Call it risk off or fear factor, whatever you want to call it, but I think of it in geopolitical space. Those three vectors don't all have to point in the same direction. You could have a situation where geopolitical risk is high, pointing to a higher gold price, but real interest rates are really high, and that would point to a lower gold price, etc.
Small ebook, big impact, The Wealth Tree. The only 4 ways that will make you financially free forever. Download it here for free.
But right now, all three of them are flashing green or maybe flashing gold. The real rates are coming down. They're still high, by the way. I always have to just roll my eyes when really smart people, Dan Isaacson, Bill Gross, Jeff Gundlach, and I admire them all and I follow them all. But they've all been carried out feet first on this, bond bubble thing, the greatest bond bubble in history, and short bonds, and the interest rates have nowhere to go but up. They're just failing to distinguish between nominal rates and real rates. Nominal rates are low. Real rates are not low. When I say low, I mean, show me negative 4%. That's a low real rate. Yeah, you can pick your notes or your bills or whatever, but I usually use the 10-year note rate, 10-year treasury, because it's a good proxy for building, construction, long-term investment. People don't borrow overnight to build a building. They borrow for 7 years if they can, et cetera. So to me, that's my proxy for sort of economic growth and inflation forecasting. That's it's about 70 basis points today, etc. But inflation is, 1.5, take your index. So that puts the real rate, maybe negative 25, negative 50 basis points. Well, thank you very much. But, I remind people in 1980, I borrowed money at 13%, but inflation was 15%. And my borrowings were tax deductible, and the tax rate, I lived in New York City at the time, was 50%. So my real after-tax rate was about negative 7. That's a low real rate. So the point is, we have a long way to go. And it doesn't matter, people are interested whether the Fed's going to pursue a negative interest rate policy, take the target rate on Fed funds below zero. Legally, they could. It's already been done in Europe and Switzerland, Japan, a few other places. I don't necessarily forecast that. I don't think the Fed necessarily wants to go there. But you can have negative yield to maturity on a 10-year note. Just whenever the premium is greater than the present value of the coupons, it's a negative yield to maturity. So you can get there. You can get deeply negative rates in secondary market trading, regardless of what the Fed does. And that will happen. And so, in the DV01, dollar value of 1 basis point is higher as the absolute level of rates gets lower. That's just, duration, just bond math 101. So we're going to have huge capital gains in 10-year notes as the yield to maturity goes, towards negative 1%. But that's going to be an enormous boost for gold. We're not even there yet. We're seeing kind of a spike in gold prices when real rates are still, relatively high. They're only mildly negative. I was declarative when I said printing money does not cause inflation, and it doesn't. Again, I'll just use the last 12 years as Exhibit A. We should probably relate to the viewers what does cause inflation. And the answer is velocity, the turnover of money, the lending and the spending. But the problem is velocity is a psychological phenomenon. The Fed can stick the landing on money supply. They can get it down to a couple of decimal places if they want. But if you want to control velocity, which is the key, that's psychological. So what you have to do is change the psychology. Well, what is the psychology right now? It's deflationary. The savings rate in May was 33%. It had been going up. It kind of made its way like from 4% to 7%, but then it spiked to 33%. Well, savings is a good thing. You can drive an economy if you can convert savings into investment. And furthermore, if the investment is productive, unlike what China's doing. But we got some infrastructure or some other projects, R&D that would be productive. That can drive an economy. You don't have to drive an economy on consumption. You can drive an economy on productive investment. But the problem is twofold. Number one, it has a much longer time frame. That's a 5-7 year time frame. And it comes, in the short run at least, at the expense of consumption. Our economy is driven 70% by consumption. If you substitute savings for consumption, you're killing velocity. Because if I put my money in the bank and leave it there, the velocity is zero. And I remind people, $5 trillion or $6 trillion times zero is zero. You can print all the money you want, but if you don't have velocity, you don't have an economy. And so the question is, how do you change the psychology? How do you get and by the way, it makes sense to say, if you're unemployed, you better be saving because you're maybe lucky if you can pay the rent. But even people who are working or still have their jobs, they're worried, maybe I'm next. Maybe they fired the guy down the hall, but maybe I'm next, and maybe I better save more just in case, and so forth. So, and that's not a bad thing. I'm not saying that doesn't make sense. That makes a lot of sense, but understand what it means. It's deflationary. It reduces velocity. It offsets the increase in the money supply, and it's very hard to get out of. Keynes called it a liquidity trap, and he was right. That's what it is. So how do you change the psychology? Well, So basically, they copied the World Bank, they copied the IMF. And I want to make 2 points. Number one, it's not like the BRICS popped up 6 months ago and said, hey, we're going to have a new currency. It's like Mickey Rooney and Judy Garland putting on a play. This has been in the works for 17 years. And it's typical Russian, Chinese. They kind of run a show, very methodical. So they duplicated the World Bank. They duplicated the IMF. Now they have applicants for membership, and there are, I think, 21 or more countries who have applied. Well, 7 have formally applied for membership. They filled out their college essay and they want to be members. And then another 13 or 14 on the waiting list, so to speak, and will perhaps eventually become members. But when you add those in, some of these will be admitted in August 22nd. That's the next big meeting, starting with Saudi Arabia. So what happens when you let Saudi Arabia into the BRICS, given the other members? You have 2 of the 3 largest oil producers in the world, Russia and Saudi Arabia. You have 2 of the 3 largest nuclear arsenals in the world, Russia and China. You have, throwing India in, and some others, you have about 50% of global population, 54% of global GDP using purchasing power parity. You can debate the method, but just if you do purchasing power parity, you get over half of GDP, 30% of the global land mass. I could go on and on. My point is that I learned development economics in the 1970s. We had something called the third world. It was Russia or, Soviet Union and the US. And then there was the third world. And all you knew about them was they were poor and, you had to get them off the runway. We actually had the runway theory of how you grow. Turned out to be wrong, but that's what we learned. Well, this is not the old third world. These are not basket cases. These are many of the biggest economies in the world that collectively have enormous power, natural resources, gold reserves, landmass, population, military. And again, I could go down the list, but this is a bloc that is as powerful in its own way by a lot of these metrics as the collective West, which I would call, US, Canada, Western Europe, Japan, Australia, New Zealand, and a few others. So that's who this group is. Now, there are a couple other groups that may join forces with the BRICS. there's something called the Eurasian Economic Union. Everyone's like, what the heck is that? Well, that's the EEU was Putin's answer. And this has been around for a long time. This goes back to the early 2000s. This was Putin's answer to the EU. He said, well, you got the EU, we got the EEU. Now it's Russia and some Central Asian republics. I'm not, Belarus and Tajikistan. I'm not saying this is France, Germany, and Italy, but it is a group that have reduced tariffs and improved trade between themselves. And there's another powerful group called the Shanghai Cooperation Organization, or the SCO, led by China. And these are mostly Central Asian republics, including Kyrgyzstan and Kazakhstan and some others. But they're all talking to each other. Now, what's the common denominator? Well, it's basically Russia and China. China's a member of 2. Russia's the only country in the world that's a member of all 3. So through pretty simple inference, you could say, hey, Russia and China are running the show. And it's very likely that when this new currency plays out, that those other countries will join in. When you do that, and I found a really cool widget. It's a map of the world that's blank, and you can go country by country and fill in by color. Just click on it and give it a color. And I did that. And I was like, oh, okay, here's the BRICS, it's 5 countries or whatever. Well, here are the applicants, it has another 20. Here's the SCO, a few more. Some of them are members of both. Here's the EEU, has a few more. Again, many are members of both. And you keep going, and all of a sudden, like a light bulb goes on. I said, that is Halford Mackinder's global island. What he called the world island. And this goes back early 20th century, first, probably greatest geopolitical theorist in history. Got to read his book if you haven't read it. It's pretty short. But he had this idea of the world island. That is exactly what they're building. Now, why is that important other than the obvious, which is, more collective economic and population power? By the way, output of wheat, pick your metric, this dominates the world. Well, for one thing, if you're going to have a currency union, the more countries you have, the more likely you are to be successful. Why? Let's just kind of digress for a second. And what are the headlines saying? Again, you correctly said, haven't we been talking about this for 10 years? Well, yeah, actually we have. But in the past year, what are the headlines? China and Saudi Arabia are talking about selling oil for yuan. Brazil and China do large multi-product currency deal where they accept each other's currency. UAE, China, same thing, selling oil for yuan. Russia, China, using yuan and rubles as payment methods for whatever they sell to each other. Russia sells natural resources, China sells semiconductors, manufactured goods, and so forth. And there are a number of those. I don't have to list them all, but there are 10 or 15 of these. The reason they've all fallen short, and very few of them have actually come to fruition despite the headlines, is when you have 2 countries and they're going to trade with each other and accept each other's currency, and you can do that, you're limited to what you can do with that currency. This is why the Russia-India thing is starting to break down. Russia's been pumping oil to India. India's been paying in rupees, but how much curry do you need? I mean, and Russia's starting to balk. They're like, hey, we're up to our eyeballs in rupees. We need a better system. Well, when you have a multilateral, multi-country currency union, that problem goes away. Russia sells oil to China. China pays in BRICS, the BRIC currency, pays you in BRIC. But Russia can take the BRIC and turn around to Argentina and say, we'd like to buy, or Brazil maybe, and we'd like to buy some Embraer aircraft. And Brazil gets the BRIC currency, and they can turn around to China and say, we'd like to buy some rice. And then China takes, et cetera. And so you've solved the quasi-barter problem. You've solved the problem of what to do with a pile of currency that you really can't use other than certain goods and services, but not everything you want. And there's an analyst who's brilliant. I read his stuff all the time. I'm like, man, you're so smart. And I just really follow him very, very closely and give him a lot of credit. But he came out a few days ago, maybe a week, and said he'd heard about this and he was kind of dismissing. He said, you can't have a currency union without a common fiscal policy. And I said, I don't want to mention his name, but I said, have you not heard of the euro? There is no common fiscal policy in Europe. Don't tell me that Italy has the same fiscal policy as the Netherlands or that Germany has the same fiscal policy as Greece. They don't. They do have a central bank that issues the currency, has a little bit of gold, but not a lot relative to the size of the economy. But there's no common fiscal policy and there's no common bond market. To this day, there's no such thing as a bond I'll call it a Eurobond, backed by the full faith and credit of the entire European monetary zone. It doesn't exist. You can buy German bonds in euros. You can buy Italian bonds in euros, but you can't buy a Euro bond backed by all those countries. So they don't have a common bond market. And they don't have a common fiscal policy, but they do have a currency union that's very successful. They finally have the scale. They finally solved this problem, which I described, which kind of is not, when you got two countries, you're not too much further ahead than barter. But with 30 countries, I spent a lot of time on the Fed. The question is, okay, what about June? They got, 6 more meetings this year. So here's the Fed's dilemma, and it's playing out in real time. So Jay Powell gave, I lost count, 7 or 8 speeches, and they said the same thing every time. He said, inflation is job one. We're on a path to raise interest rates. We're not going to quit until inflation is under control. Now, there's a little wiggle room around that. Their target is 2. They actually look at personal consumption expenditure year over year, core. That's their metric. There are 15 ways to measure inflation, but that's the one they like. But even that is still over close to 5. It's a long way from 2. That's the point. You're trying to get to 2. They're a long way from 2. But there's something called the terminal rate. What's the terminal rate? Well, no one knows the number. I don't know because Jay Powell doesn't know. So we're all estimating. But the terminal rate, it's a rate that's high enough to bring down inflation on its own without further rate hikes. In other words, we can stop here and confident that inflation is going to come down without doing more. Because the conundrum is, okay, they've been raising rates since March 2022. Monetary policy works with a lag. Inflation peaked in July 2022, and it has been coming down ever since. Some months were, January was hot compared to December, but the trend has been down. So they're raising rates and inflation is coming down. So that's good. But here's what they don't know. Was inflation coming down because they were raising rates, or had they already hit the terminal rate and they just didn't know it? Because Wall Street was like, no, you've hit the terminal rate. Stop, please stop. You got this under control. The Fed doesn't believe that. One of the greatest blunders in monetary policy was Paul Volcker in 1980, who had started raising rates in 1979, and inflation was coming down. But then in 1980, we had a very sharp recession that had nothing to do with monetary policy. It wasn't caused by Paul Volcker. Jimmy Carter put a cap on credit card interest, and banks stopped issuing credit cards. Well, that'll sink the economy. And then so Volcker reacted to that by lowering interest rates 7 percentage points, not 70 basis points, 7 percentage points, because we're in a recession, right? That's what Feds do. The Fed chairs do. But because it was a regulatory blunder, they fixed it and the economy came roaring back. And then inflation really took off, worse than when Volcker got in 79 and early 1980. So Volcker had to take rates to 20% to get inflation under control the second time after cutting them in 1980. And that's called the Volcker mistake or the Volcker blunder. And Volcker himself, I spoke to him, he said, yeah, that was a mistake, that I should have stuck to my program, not worried about the economy and unemployment, but just got inflation under control. But when he threw in the towel prematurely, the inflation went to the moon. Jay Powell doesn't want to be that guy. Jay Powell knows that episode as well as I do. And he doesn't want to be the guy who throws in the towel early and then inflation just goes to the moon and then then he has to take interest rates to 15% or something ridiculous. So Wall Street's saying, you're already there, mission accomplished. Powell's saying, not so fast. They told Volcker that and he cut rates and it was an enormous mistake. So Powell's not going to be that guy. So what is the terminal rate today? I would say 5.5, because we had a lot of hot data, unemployment down, job creation up, retail sales up, not to the moon, but these are the opposite of what Powell is looking for. So he's had no confirmation that inflation is coming down on its own. He's had a lot of data that says inflation may be getting ready to take off again. So you got to say the terminal rate went from 5.25 to 5.5, maybe more. Let's see what he does in June. And Powell always said, I don't care if there's a recession. I don't care if there's unemployment, because the long-term costs of inflation are going to be much greater than those short-term problems. We got to suffer through that to get a bigger problem under control. He thinks of inflation. He said this many, many times. Now, along comes Silicon Valley Bank. Okay. Oh, by the way, in addition to raising rates, don't forget QT, quantitative tightening. They were shrinking their balance sheet. It's very hard to estimate the monetary impact of shrinking the balance sheet, but the best estimate is for every $1 trillion you take it down, it's probably equal to a 1 percentage point hike in the Fed funds rate. So the tightening has been more than just taking the Fed funds rate up. You also have to take into account QT. Now let's go back to the bond guarantee and bailing out the entire banking system. The Fed proceeded to guarantee every deposit and every bank in the entire U.S. banking system. Here we're talking, $6 or $7 trillion of assets. And the way they did it was a lot of other banks, big ones and small ones, at least the big ones had good risk management, but a lot of small and medium-sized banks, they had the same problem Silicon Valley Bank had. Maybe the depositors weren't walking out the door, or maybe they weren't funding tech startups, but they had underwater bonds and overnight deposits and were facing the same thing. So the Fed said, okay, all you banks, if you send us your bonds, we'll give you cash. Okay, that's just a normal discount operation, but that will give you cash equivalent to the par value. So again, remember the market value is like 80 cents on the dollar, but the Fed says we'll give you 100 cents on the dollar. So now you ship your bonds to the Fed. They give you not 100%, which is like low collateral, but they give you 120%. So the banks are shipping in bonds that are worth 80 cents on the dollar. Why wouldn't you do that? I'm like, hey, Fed, if you want to give me a low interest rate bridge loan with 80% down, I'll take all you got. So now the banks are going to do that. And by the way, because it's structured kind of like a repurchase agreement, there's no sale. So they don't have to market to market. If you sold it to a third party, a dealer, you'd have to take the loss. But now they don't have to take the loss. So they're shipping in billions, potentially $1 trillion or more of these bonds. They're not getting 80, 90 cents on the dollar, which is what they're worth. They're getting 100 cents on the dollar, which was the original purchase price. They don't have to take the loss, and they're getting cash. Why wouldn't you do that all day long? So in effect, they bailed out the entire banking system to the tune of trillions of dollars. They just blew up the $250,000 limit. Forget that. I mean, I know what the statute says, but they threw that out the window. And the moral hazard, the economic consequences, the repercussions of this are kind of unimaginable. I mean, I can sketch them. I can talk about them. To hear Janet Yellen say it's not a bailout. Are you kidding me? This is the biggest bailout in history. And I negotiated the LTCM bailout. I lived through that. That was $1 trillion of derivatives. Through 2008, 2020, the pandemic, I go back to 1994, the Mexican tequila crisis. I've lived through all these and been more or less directly involved in all of them. And this is orders of magnitude greater in terms of what's being bailed out. Doesn't that mean that a lot of banks will be sending the bonds to the Fed and getting cash? Yeah, that's exactly what it means. Well, where's the cash come from? You got to print it. So on the one hand, we're doing quantitative tightening by letting bonds mature and not reinvesting. But on the other hand, you just send an open invitation, open party, house party to every bank in the country saying, send us your bonds and we'll give you cash. Not only that, but 100 cents on the dollar, even if they're worth 80. So you're going to have potentially trillions of dollars of new money being printed at a time when the Fed's trying to get inflation under control and they were trying to shrink the balance sheet. They're going to be expanding the balance sheet. So, I mean, there's no way out. There's no good way out of this. You can pause. I don't think they will, but you could pause and not raise rates, right? And implicitly saying we're not going to raise rates for the foreseeable future because we got all these losses in the banks. Okay, inflation goes to the moon. I promise you it'll just take off like a rocket. Or you can raise interest rates 25 basis points and we'll continue this war on inflation, but you're just going to increase the bond losses in the banks and make them send you more bonds and get more cash. Or the third thing is just take away the umbrella and let all these banks fail. I mean, it's like name your poison. Name your poison. You can have runaway inflation, severe acute banking crisis, or basically a lot more, as I say, a lot more bank failures and a severe recession because you're going to keep raising rates. There are three choices, but none of them are good. Inflation is coming down, by the way. And having said that, the target is 2%. So he's not there, but he's making progress. Now, Wall Street's saying, you're done. You did it. Mission accomplished. Inflation is coming down. You got what you wanted. Give it time. Stop raising rates. You're going to kill the economy. But the Fed is saying, well, we actually don't know. We can't untangle it. Yes, inflation is coming down. That's objective. But is it coming down because we're still raising rates? Or is it coming down because we're at the terminal rate? Those are two different things. And right now, and this is what Powell's been saying, the Fed leans to the view that they're not at the terminal rate, that inflation is coming down because they're raising rates. They have not achieved the terminal rate. So my expectation is the Fed will raise interest rates 25 basis points in March. March 22nd is the Fed meeting. After that, that'll get you to 5.25. And even the more hawkish members think that that's probably the terminal rate. So Powell and the Fed have said, yeah, inflation's coming down, but it's because we're raising rates, not because we're at the terminal rate. We're going to get to the terminal rate, probably 2 more hikes, and then we'll pause. And then if we're right, we'll just let inflation come down on its own. And that may take a year. So all this stuff about the Fed pivot and cutting rates and all that stuff, I mean, the Fed's thinking mid 2024 before they do that. Now, Wall Street, and I'll say markets, not just Wall Street, but the big money in places like the Eurodollar futures curve and the U.S. Treasury curve, which are highly inverted, are saying, no, you're not going to get that far. You may be at the terminal rate already. You're definitely going to cause a recession. It'll be more severe than you think. And rates are going to have to come down sooner than people expect. In other words, you've already achieved the terminal rate. You just don't know it. And you'll probably be the last to know. So with Wall Street, with the cheerleaders, sending that message, but with some serious market indicators, including yield curves, sending that message. Why is Powell sticking to the game plan as I described it? And the answer goes back to 1980, believe it or not, and what's called the Volcker mistake. And everyone knows, Volcker became Fed chairman in 1979. He stayed on until the early to mid 80s. And he did raise interest rates to 20% or very close to it to kill inflation, which went up to 15% at the time. But people forget that there was a recession in 1980. It was sharp but quick. It was over very quickly. It had nothing to do with monetary policy. The Carter administration issued some dopey regulation on a ceiling on credit card interest rates. And the industry said, fine, we're just not going to lend anybody any money. The economy fell instantly, kind of like a smaller version of what happened in 2020 with the pandemic panic. And then they said, oh, sorry, just kidding. And then they took the ceiling off and then things got back to normal. Now, this was a time when farmers around the country were driving front loaders and tractors to Washington, and they were circling the Fed building. And one guy drove his tractor up the steps of the Fed, and Volcker was being burned in effigy. That all happened. So it was a little bit of pressure. And of course, Congress was up in arms and the White House was up in arms. So Volcker, not quite panicked, but he cut interest rates 7 percentage points, not 0.7, 7 full percentage points to deal with the recession, which, number one, was unnecessary because the recession was caused by a policy blunder from the White House, which was quickly corrected. And number two, he had not won the fight against inflation. Well, after he cut rates, and we came out of that very quick sort of snap recession, inflation got even worse. And that's when Volcker had to raise rates to 20%. And Volcker, in hindsight, he said, we shouldn't have done that. We should have stuck to our inflation mission. So now Powell, remember, Powell's not an economist. He's a lawyer. So he kind of thinks like a lawyer. I can relate to that, looking at both sides. Powell does not want to be that guy. He does not want to be the guy who balks early and cuts rates, the famous Wall Street pivot, before the battle against inflation is won, because the outcome could be exactly what Volcker experienced, which is inflation wasn't done, doesn't go away, comes back stronger, and then you do have to destroy the economy, as we did in 1981-82. That was the worst recession. That was far worse than the little one in 1980. That was the worst since the Great Depression. We've managed to break that record several times since then, but at the time that was horrific. But Volcker and others have said that was a blunder he never should have done. So Powell does not want to give up the rate hikes too early because he does not want to repeat the Volcker mistake. He does not want to be that guy. And that's what's driving him, even as Wall Street screams, you're already there. So the question is, how does this play out? In my view, Powell probably is there. He probably is at something like a terminal rate. He probably doesn't have to raise interest rates anymore. He doesn't believe that himself. His models tell him otherwise because they're relying on the Phillips curve, which is junk science. I mean, the last time I looked at a Phillips curve, it was flat. At least where I went to school, curve was curved. This thing is flat. There is no correlation between unemployment and inflation. There just isn't. But the Fed thinks there is. So I always tell people, if you want to forecast Fed policy and understand the Fed, don't think like a rational person. You have to think like the Fed. You have to get inside their heads or else you're going to get it wrong. So they're looking at unemployment, which is the lowest. The unemployment rate is the lowest since 1969. Well, if you believe in the Phillips curve, then that's a sure sign of inflation. As I say, even though it's coming down, it's still pretty high. They think they have to keep fighting this fight. But here's what they're missing. Here's where it all falls down. Yeah, inflation as measured, CPI, PPI, personal consumption expenditure, core, non-core, year over year. There are like 20 different ways to measure it. It is coming down, but there are two sources of inflation. And it's going to sound obvious, but you got to separate them, the supply side and the demand side. Both result in price increases, but they have completely different dynamics. Supply side inflation is what we're seeing. It's what we saw in 1974 with the Arab oil embargo during the Arab-Israeli war when they cut us off from oil. And, you had to line up for gasoline. I lived through that. now, and again, this is what my book Sold Out is about, the breakdown of the supply chain, partly related to energy, partly related to the war in Ukraine, partly related to the pandemic panic. As I explained in the book, it actually predates that. The breakdown started in 2018 with Trump's trade war, and then COVID made it worse, yes. Ukrainian war made it worse, yes. But it really started before that. So, of course, prices went up and people were trying to pay whatever they had to get what they needed. And energy prices were a big driver of that. So that feeds through as a form of inflation. The other kind of inflation is from the demand side. So the supply side is called cost push. Costs go up and they push it onto the consumers. The other kind is from the demand side. It's called demand pull. And basically consumers have a change in mentality. They're worried about inflation. They would say, hey, I was thinking about buying a refrigerator. Gee, I better go buy it today because if I wait for 6 months, the price is going to go up. Or apply that to anything, a new dress, new suit of clothes, whatever. And so you're pulling demand forward and it's behavioral. And that will also drive prices up. But they're very different things. Now, cost push can morph into demand pull. That's what happened in the 70s. It started from the supply side, but by the late 70s, 80s, and Volcker, which we've just been talking about, it had tipped over into the demand side. That hasn't happened yet. We've had the supply side inflation, the cost push. It hasn't yet tipped into demand pull. It hasn't really affected consumer behavior that much in terms of people anticipating more inflation. It could, but it hasn't happened yet. Here's why that's an important distinction. Cost push inflation negates itself. You know, the old saying that the cure for high oil prices is high oil prices. So it tends to negate itself, whereas demand pull feeds on itself. Powell has not made that distinction. And if I'm right, I think I am right, and the evidence backs that up, this inflation will come down, not because the Fed is raising interest rates, but because higher prices destroy demand all on their own. So it does tend to depress demand, destroy demand, and hurt the economy. Russia had about 600 tons of gold, and today they have 2,300 tons. China had about 600 tons of gold, and today they have about 2,000 tons, just slightly less, that we know of. And they may have several thousand tons off the books in the State Administration of Foreign Exchange that we don't know about because that's completely opaque. So Russia and China did exactly what we warned the Pentagon about in 2009, exactly, which is increase their gold reserves by a factor of 4 or more. When you talk about reserve currency, you have to understand what that means. It's not like the People's Bank of China has a bunch of $100 bills on pallets stacked up in the basement. When people say reserve currency, what they really mean is the currency of the bonds that they invest in. In other words, they're dollar-denominated assets in the form of treasury bonds or notes. That's what China actually has on their books, not like the dollars per se. What I was hypothesizing then, and I'll come back to this, is you can create a brand new currency that does have all that stuff. And in my example, they used a Swiss bank, UK law, put the gold in a third-party depository. If you wanted some of the new currency, you could deposit your own gold and get some of the currency or trade with them or run a surplus. So it was a replacement system, but you would need the gold to instill confidence. They don't have bond markets, and they're not going to have them soon. So the yuan and the ruble aren't going to replace anything. Well, the repercussions may be felt for 10 years or longer, but the immediate impact is going to go well beyond the so-called sanctions. What the point I was really making was we're slapping sanctions on Russia. Russia is hitting back with some retaliatory actions, and it's pretty easy to look at the direct impact of that, but there's second-order and third-order effects that will pop up all over the world and could very quickly get out of control. Think of it as the economic equivalent of a nuclear war. Nobody wants a nuclear war. But the one thing they all said in common, the one thing they all shared was, don't go there. And what they meant was that nobody wakes up and says, oh, gee, I think I'll start a nuclear war today. What a good idea. That never happens. What does happen is you get into an escalatory situation, back and forth, where you're escalating, and you end up in a nuclear war. You never intended it, never started out that way, but you end up there through escalation. Now take that is good analysis, take that and apply it to what is now, I would say, the first full-scale economic war, sanctions war. We've had sanctions for a long time, and going back to at least the 70s with Iran, but even before that, I mean, FDR put sanctions on Japan. Nothing on this scale. This is unprecedented in its scope and application. And my only point is the effects of this are going to not just last a long time, yes, but they're going to pop up in very, very unexpected places. I did. Let me make the point. There was never a war that was easier to prevent. There's never been a war that's easier to prevent, and there's never been a war that's easier to end. You could end this war in 48 hours or less. Having said that, I did expect that through a series of policy blunders and escalation, in this case, military escalation and political escalation, and then later in the book, around on page 250 or so, I have a whole section on Ukraine, Russia, and natural gas. So this has been brewing for a long time. You can go back to the 2008 Bucharest Declaration, but if you wanted to pick one thing and say, hey, when did this thing take a turn for the worse?
Right. So
that we were on a path to war. That was the color revolution sponsored by Obama and Biden, which was a coup d'etat. I mean, the president of Ukraine at the time, he was pro-Russian, and Obama set out to depose him, and they did. And they put in Poroshenko, who was a U.S. puppet, and at the same time, like 2 months after the color revolution, 1 month before Poroshenko, Putin took Crimea. He said, okay, that's how you want to play, fine. You move away from neutrality, move towards NATO, I'll take Crimea, your move. And then there was nothing, Putin didn't take one square inch during the Trump administration, because Trump is highly unpredictable, but put Biden back in, who was part of the original Obama-Biden team. And so not only was Trump not in Putin's pocket, he was the only one who stood up to Putin in such a way that Putin didn't take one square inch of territory. He took Crimea under Obama. Now he's taking kind of half the country under Biden. Didn't take anything under Trump. So that completely debunks that. But just to take it one step further, who is in the pocket of the Ukrainians, at least? And the answer is Joe Biden, because of Hunter Biden, who made millions of dollars from Burisma, their large natural gas company. Ukraine is ranked in the low 90s of the most corrupt countries in the world. In other words, it's at the bottom on a corruption list with the most honest countries being on top. Ukraine is very close to the bottom. It's the most corrupt country in Europe, one of the most corrupt countries in the world. Zelensky is just another oligarch, just another phony. Now, you can take sides, but to me, Putin's a dictator, Zelensky's a dictator. Pick your dictator. But this idea that he's some good guy Democrat is nonsense. Well, it's a phone call, basically. I mean, Biden's kind of non-compos mentis, but somebody who can string a few sentences together needs to call Zelensky and say, here's what we're going to do. You're not going to join NATO. We'll get the NATO Secretary General, John Stoltenberg, to say that. You need to say it, and the U.S. will say it. So you're not going to join NATO. You're not going to join the EU. You can be independent in the sense of being autonomous, but you have to be neutral. When you've got two great powers, whether it's the U.S. and Russia, or the U.S. plus Europe and Russia confronting each other, the idea of buffer states, I mean, that's as old as, if not history, at least the history of buffer states is several centuries old at this point. It's a part of what every international strategist looks at. So Ukraine should be a buffer state. It should be neutral. That way Putin has no reason to invade, and we have no reason to try to push the borders of NATO to a point slightly east of Moscow, which Moscow hasn't been attacked from the east since Genghis Khan. These sanctions will not work to stop the war or slow the war or change the outcome of the war. Now, they absolutely punish the Russian economy. Yep. They punish Russian individuals, consumers, Russian citizens. They're going to have fewer options, more expensive goods. Their economy is going to slow down. Unemployment will go up. The ruble is devalued. All those things are true. But they're also true in the United States. We're going to punish Americans far worse than the Russians. We're already seeing, I took a long trip yesterday. I filled up my car with gas at the end of the trip. It was $76. Inflation's here. We all see it. Price of gasoline, eggs, milk, butter, groceries at the store, rents, electricity, home heating, fuel, you name it. Across the board, inflation's affecting everything. And it started really in mid-2021. So here we are almost 2023. So that's been going on for well over a year. For the first 6 or 7 months, Jay Powell and, for that matter, Janet Yellen were like, yeah, we see it, but it's transitory. We know that story. Finally, November 2021, Jay Powell threw in the towel, said, okay, time to retire the word transitory. Now let's get to work. And they started raising interest rates in March 2022. And we're now up to Fed funds rate of 4%. They're going to raise them again in December 14th by another 50 basis points. We kind of, still a little bit away from that, but we know it's coming. The Fed, this is the no drama Fed. They tell you what they're doing in advance. So I always say you don't need a crystal ball to figure out the Fed. You just need to listen to what they're saying and believe them. So they're going to do 50 basis points in December. That'll get the policy rate of the Fed funds target rate to 4.5%. But that's from zero. March 1st, it was zero. So to go from 0 to 4.5 in less than 9 months, about 8.5 months, that's amazing. We haven't seen anything like that since Paul Volcker in the early 80s. Now, I know rates are not 13, 14%, but to go from 0 to 4.5, I can say in 8 months is a shock. Now, why is the Fed doing this? Well, they say they want to kill inflation. Okay, but there are two sources of inflation. Inflation can come from the supply side, what's called cost push inflation. Costs go up and they get pushed into retail prices and consumer prices, and that is what's happening. That's because of the supply chain breakdown, energy prices, shortages of goods, etc. So that's cost push inflation from the supply side. There's another kind of inflation that comes from the demand side. And this is much more psychological. It's when consumers say, they just have it in their heads and maybe from objective data that prices are going up. And so they change their behavior. They say, I was thinking of getting a new washing machine, but I was going to wait 6 months, but I better buy it now because the price is going to be a lot higher in 6 months. Or a car, or, suit of clothes, a dress, furniture, whatever it is, better buy it now because the price is going to go up. It's going to get worse. Inflation is here to stay. Commodities are going to boom. Oil prices are going to soar. Bonds are going to crash. And gold has been in a very funny situation, which is the following. Normally, you say, well, if there's inflation coming, why isn't the price of gold going to the moon? And why on earth would gold prices go up if there were deflation or disinflation? The answer is that you have to look at the yield to maturity on the 10-year Treasury note. That's our benchmark security. A lot of people look at LIBOR, but I'm like, no, if you're making investment decisions, you're buying a house, you're doing capital investing, these are all 5, 10, sometimes 20-year decisions. The 10-year note is the right benchmark for those large, long-term investments. Well, that's an alternative place to put money. You can buy gold, you can buy a 10-year Treasury note. So what's been true since last summer is as the yield to maturity on the 10-year note goes up, that strengthens the dollar, and gold prices have gone down because the dollar price of gold is just another cross rate, just another cross exchange rate. So a stronger dollar means a lower dollar price for gold. But if the yield to maturity in the 10-year note goes down, then that weakens the dollar and the dollar price of gold goes up because a weaker dollar means a higher dollar price for gold. So curiously, the price of gold is being driven not by inflation in the abstract, but by the strength of the dollar, which is reciprocal to the interest rate on the 10-year Treasury notes. But here's what has changed. I talk about gold bull markets and gold bear markets, and I start my analysis in 1971, and I don't have to go through all that data, but that's how I think about it. And you're like, well, Jim, why 1971? Why not before that? And of course, 1971, it was when Nixon stopped redeeming dollars for gold. Americans couldn't even own gold in 1971. It was contraband. It was like drugs or machine guns or something. But foreign trading partners could redeem dollars for gold up until 1971. And then Nixon said no more. And then that was the final decoupling. But prior to that, gold was actually money. In other words, under Bretton Woods, gold was pegged at $35 an ounce. Prior to Bretton Woods, it was pegged at $20.67 an ounce. So going back to the 1920s or earlier, through most of the 19th century. For the United States and sterling, I think it was $4.75. It could be off a little bit on that, but four pounds and change. And as late as World War I, say 1913, if you were a Brit and you were getting on the steamer from London to at the time Bombay, today Mumbai, you took a purse of British sovereigns. British sovereign is about 8 grams, a little bit less. It's not an ounce; it's a quarter ounce, because an ounce is almost too much. Even today, what are you going to do with a 1 ounce coin that's worth almost $2,000? You're not going to use that to buy a pack of gum. But in the day, there was the quarter ounce, which today would be, like a $500 bill. So it's still a significant amount of money. But you could get on the steamer in Southampton and get off in Bombay at the time, and it was money good. You could take that British sovereign and spend it anywhere. And same thing in Singapore and Hong Kong and Japan or all around the world. So gold was actually money. So it wasn't a question of, what's the exchange rate? It was, the gold was the money, and people thought about it by weight. They said, a sovereign, that's 8 grams of gold. So that's worth, that'll get you whatever. So, and that was true throughout history. And so it's really only since 1971, when we decoupled completely in terms of an exchange rate, that you have to think about, what's the dollar price of gold? Because it's not fixed. But okay, well, what happened to the memory? What happened to the 3,000 years I just talked about? Well, the answer is it happened in stages, and it actually took about 75 years. So it began in 1914. 1914 was the outbreak of World War I. Everybody needed gold. There was a run on gold, and countries needed gold because they knew they would need gold to pay for the war, to try to win the war. Well, it didn't matter if you're Germany, UK, or whoever. And remember, the United States was neutral. The United States did not get in the war until 1917. The war started in 1914. So for those first 2.5 years, New York was a money center to all of Europe, to all the belligerents. So everyone scrambled for gold. So if you were a citizen, they asked you to bring your gold to the bank, and they gave you paper money. But people did it out of a patriotic. It's existential. War is not a normal market. If you lose the war, you got bigger problems than your gold. And so people put the gold in the banks. What did the banks do? They melted it down and made 400-ounce bars. And they said, don't worry, your money's backed by the gold, but keep using that paper money, but it's redeemable for gold. But, oh, by the way, they're 400-ounce bars. Nobody walks around with a 400-ounce bar in her purse. I'm sure you've seen one, and I have as well. They're heavy. They weigh about 35 pounds. You don't walk around with them. So all of a sudden, the gold was still there, and the paper money was backed by gold in theory, but the gold had disappeared into the banks. That's step one. Step two, and this happened in the 1930s, the central banks took the gold from the commercial banks. So first, the commercial banks took the gold from the people. Then the central banks took the gold from the commercial banks, and the Federal Reserve System told all the banks, hey, send your gold to the regional Federal Reserve Bank. And of course, most of it went to the Federal Reserve Bank in New York. So now it's not even in the banks anymore, right? But you're still walking around thinking your paper money is somehow attached to gold. But people haven't seen gold for a while, unless you're a collector. Step three, the United States Treasury and the finance ministries took it from the central bank. In 1934, the United States Treasury seized the gold of the Federal Reserve System. Bearing in mind, the Federal Reserve System is privately owned. And they gave them a gold certificate. And you go to the Federal Reserve System website today and, hunt around a little bit on the links and find the balance sheet of the Federal Reserve, and it's there. And look in the assets. And the first line item is gold certificate, and it's valued at $11 billion. But that's because they value the gold at $42 an ounce. And I've revalued it, the answer is at today's market, that $11 billion is actually worth $470 billion. So the Fed has a hidden asset of $450 odd billion that's not on the balance sheet, represented by a gold certificate. But it's not the gold. The Treasury has the gold. And by the way, where do we keep our gold? I'm talking about the United States. The Treasury owns the gold. The Fed has a paper certificate. The gold is on 2 Army bases, West Point and Fort Knox. So I would say the Army has the gold. Gold has gone from citizens walking around having it in your purse, to commercial banks, to central banks, to finance ministries, held on an Army base. It's still there. The gold didn't disappear. But nobody talks about it, and everyone pretends it's not money. But of course it's money. But meanwhile, what's happened to the civilian population, the citizens? We stopped talking about it. We stopped saying it. We stopped learning about it. I remind people, just showing my age, but I got a graduate degree in international economics, and I was class of 74. But that was the year the IMF demonetized gold. But I was the last class that was taught gold in an academic setting as a monetary asset. If you're younger than I am and you know anything about gold, you're either self-taught or you went to mining college, because they just stopped teaching it. So now we have two generations of scholars who never learned a thing about gold. So they hid it, they took it, they buried it, they stopped teaching it, they stopped talking about it, and they pretended it's not there. Meanwhile, it is there. And Russia is a good example of someone who takes it seriously. In the U.S., we still have our 8,000 tons, 8,133 tons. We haven't given it away. We haven't sold any gold since 1980, by the way. We got the British to do it. We got everyone else to do our dirty work. The British sold more than half. No, seriously, the British sold more than half their gold. The Swiss sold 1,000 tons. The IMF sold 400 tons in 2010. That was the last significant sale by a monetary institution. Australia sold most of theirs. Canada sold most of theirs. If I were one of these other countries, I would say to the U.S., hey, why don't you sell some of your gold? But the U.S. doesn't. We haven't sold an ounce since 1980. Inflation is coming down, by the way. And having said that, the target is 2%. So he's not there, but he's making progress. Now, Wall Street's saying, you're done. You did it. Mission accomplished. Inflation is coming down. You got what you wanted. Give it time. Stop raising rates. You're going to kill the economy. But the Fed is saying, well, we actually don't know. We can't untangle it. Yes, inflation is coming down. That's objective. But is it coming down because we're still raising rates? Or is it coming down because we're at the terminal rate? Those are two different things. And right now, and this is what Powell's been saying, the Fed leans to the view that they're not at the terminal rate, that inflation is coming down because they're raising rates. They have not achieved the terminal rate. So Powell and the Fed have said, yeah, inflation is coming down, but it's because we're raising rates, not because we're at the terminal rate. We're going to get to the terminal rate, and then we'll pause. And then if we're right, we'll just let inflation come down on its own. And that may take a year. So all this stuff about the Fed pivot and cutting rates and all that stuff, I mean, the Fed's thinking mid-2024 before they do that. Now, Wall Street, and I'll say markets, not just Wall Street, but the big money in places like the Eurodollar futures curve and the U.S. Treasury curve, which are highly inverted, are saying, no, you're not going to get that far. You may be at the terminal rate already. You're definitely going to cause a recession. It'll be more severe than you think, and rates are going to have to come down sooner than people expect. In other words, you've already achieved the terminal rate. You just don't know it, and you'll probably be the last to know. So with Wall Street, with the cheerleaders, sending that message, but with some serious market indicators, including yield curves, sending that message, why is Powell sticking to the game plan as I described it? And the answer goes back to 1980, believe it or not, and what's called the Volcker mistake. And everyone knows, Volcker became Fed chairman in 1979. He stayed on until the early to mid 80s. And he did raise interest rates to 20% or very close to it to kill inflation, which went up to 15% at the time. But people forget that there was a recession in 1980. It was sharp but quick. It was over very quickly. It had nothing to do with monetary policy. The Carter administration issued some dopey regulation on a ceiling on credit card interest rates. And the industry said, fine, we're just not going to lend anybody any money. The economy fell instantly, kind of like a smaller version of what happened in 2020 with the pandemic panic. And then they said, oh, sorry, just kidding. And then they took the ceiling off, and then things got back to normal. Now, this was a time when farmers around the country were driving front loaders and tractors to Washington, and they were circling the Fed building. And one guy drove his tractor up the steps of the Fed, and Volcker was being burned in effigy. That all happened. So it was a little bit of pressure. And of course, Congress was up in arms and the White House was up in arms. So Volcker, not quite panicked, but he cut interest rates 7 percentage points, not 0.7, 7 full percentage points to deal with the recession, which, number one, was unnecessary because the recession was caused by a policy blunder from the White House, which was quickly corrected. And number two, he had not won the fight against inflation. Well, after he cut rates and we came out of that very quick sort of snap recession, inflation got even worse. And that's when Volcker had to raise rates to 20%. And Volcker, in hindsight, he said, we shouldn't have done that. We should have stuck to our inflation mission. So now Powell, remember, Powell's not an economist, he's a lawyer, so he kind of thinks like a lawyer. I can relate to that, looking at both sides. Powell does not want to be that guy. He does not want to be the guy who balks early and cuts rates, the famous Wall Street pivot, before the battle against inflation is won, because the outcome could be exactly what Volcker experienced, which is inflation wasn't done, doesn't go away, comes back stronger, and then you do have to destroy the economy, as we did in 1981-82. That was the worst recession. That was far worse than the little one in 1980. That was the worst since the Great Depression. We've managed to break that record several times since then, but at the time that was horrific. But Volcker and others have said that was a blunder he never should have done. So Powell does not want to give up the rate hikes too early because he does not want to repeat the Volcker mistake. He does not want to be that guy. And that's what's driving him, even as Wall Street screams, you're already there. So the question is, how does this play out? In my view, Powell probably is there. He probably is at something like a terminal rate. He probably doesn't have to raise interest rates anymore. He doesn't believe that himself. His models tell him otherwise because they're relying on the Phillips curve, which is junk science. I mean, the last time I looked at a Phillips curve, it was flat. At least where I went to school, curve was curved. This thing is flat. There is no correlation between unemployment and inflation. There just isn't. But the Fed thinks there is. So I always tell people, if you want to forecast Fed policy and understand the Fed, don't think like a rational person. You have to think like the Fed. You have to get inside their heads or else you're going to get it wrong. So they're looking at unemployment, which is the lowest. The unemployment rate is the lowest since 1969. Well, if you believe in the Phillips curve, then that's a sure sign of inflation. You know, as I say, even though it's coming down, it's still pretty high. They think they have to keep fighting this fight. But here's what they're missing. Here's where it all falls down. Yeah, inflation as measured, CPI, PPI, personal consumption expenditure, core, non-core, year over year. There are like 20 different ways to measure it. It is coming down, but there are two sources of inflation. And it's going to sound obvious, but you got to separate them, the supply side and the demand side. Both result in price increases, but they have completely different dynamics. Supply side inflation is what we're seeing. It's what we saw in 1974 with the Arab oil embargo during the Arab-Israeli war when they cut us off from oil. And, you had to line up for gasoline. I lived through that. Now, and again, this is what my book Sold Out is about, the breakdown of the supply chain, partly related to energy, partly related to the war in Ukraine, partly related to the pandemic panic. As I explained in the book, it actually predates that. The breakdown started in 2018 with Trump's trade war, and then COVID made it worse, yes. Ukrainian war made it worse, yes. But it really started before that. So, of course, prices went up and people were trying to pay whatever they had to get what they needed, and energy prices were a big driver of that. So that feeds through as a form of inflation. The other kind of inflation is from the demand side. So the supply side is called cost push. Costs go up and they push it onto the consumers. The other kind is from the demand side. It's called demand pull. And basically consumers have a change in mentality. They're worried about inflation. They would say, hey, I was thinking about buying a refrigerator. Gee, I better go buy it today because if I wait for 6 months, the price is going to go up. Or apply that to anything, a new dress, new suit of clothes, whatever. And so you're pulling demand forward and it's behavioral. And that will also drive prices up. But they're very different things. Now, cost push can morph into demand pull. That's what happened in the 70s. It started from the supply side, but by the late 70s, 80s, and Volcker, which we've just been talking about, it had tipped over into the demand side. That hasn't happened yet. We've had the supply side inflation, the cost push. It hasn't yet tipped into demand pull. It hasn't really affected consumer behavior that much in terms of people anticipating more inflation. It could, but it hasn't happened yet. Here's why that's an important distinction. Cost push inflation negates itself. The old saying that the cure for high oil prices is high oil prices. So it tends to negate itself, whereas demand pull feeds on itself. Powell has not made that distinction. And if I'm right, I think I am right, and the evidence backs that up, this inflation will come down, not because the Fed is raising interest rates, but because higher prices destroy demand all on their own. So it does tend to depress demand, destroy demand, and hurt the economy. And then it slows down, and then the inflation comes down on its own. That appears to be happening. But Powell hasn't really made the distinction. He's fighting the last war. I hate to use a cliche, but he's fighting the Volcker war. Powell doesn't want to repeat the Volcker mistake. He thinks the battle's not won. He has to get to the terminal rate. In reality, he's probably already there. The future is very positive for gold. You have the normal vectors. Supply is flat, but has been for 6 years. Demand is going up. Central banks have flipped from net sellers to net buyers. That's a big deal. Retail and institutional interest is higher, so that's good. Geopolitical threats, don't need to say a lot. From the U.S. perspective, Iran, China, North Korea, Venezuela, Russia, you name it. So that's the vector. But the biggest driver right now is what I referred to a few minutes ago, negative real rates. because gold as a form of money, which is how I view it, competes with other competes with other instruments, treasury bills, etc. Well, if they have high yields and gold has no yield, you want the treasury bills. But if interest rates have negative yields and gold's just flat, gold looks more attractive. So that's the main driver, and that's going to continue. Everyone's like, well, the gold is up, gold is down. So what do you mean when you say that? And they're talking about the dollar price of gold. And it's like, okay, so the dollar price of gold is up or down. That's really a cross rate. That's no different than talking about the euro US dollar exchange rate or Australian dollar US dollar exchange rate. If you think of gold as money, and I do, then the dollar price of gold, with gold measured by weight, not as another currency, it is another form of money, but with gold measured by weight, it's a cross exchange rate. When the price goes up, I would say that what's really happening is the dollar is going down. In other words, I think of gold by weight. I'm interested, do you have a ton? Do you have 50 kilos? Do you have 5 ounces? Whatever you have as an individual investor or as a bank, I think of it by weight. Because when someone said gold's really going up, I said, well, no, the dollar's going down. You need more dollars to purchase a fixed quantity of gold, which means the dollar's worth less. And when people say gold's really going down, I say, no, the dollar's worth more, and you need fewer dollars to purchase a quantity of gold. When people talk about price, the first thing they do is they're really talking about dollars. There's a euro price for gold, but the world market is based on dollars. You're privileging the dollar as the numeraire. The numeraire is your counting system. Is it yards, inches, feet, whatever? And if you put the dollar first and say gold is in dollars and it's going up or down, I think you have it backwards. I think you need to put gold first by weight. And then if it's worth more, the dollar's going down. If it's worth less, the dollar's going up. And so when you say gold is going up, let's say it went to $2,000 an ounce, everyone say, oh, the price of gold went up, just went up 10%. Well, did it, or did the dollar go down? The way I would phrase it is, it used to be $1,800 to get an ounce of gold. Now it's $2,000 to get an ounce of gold, or, your dollar got you 1/1800th of an ounce. Today, it only gets you 1/2000th of an ounce. In other words, gold didn't do anything. It's a metal, it's an element, atomic number 79. What happened was the dollar got stronger. So a stronger dollar is a lower dollar price for gold, and a weaker dollar is a higher dollar price for gold. So when people talk about gold going up, what they're really talking about is the dollar going down.
We have new numbers regarding how much gold central banks are buying, 400 tons in Q3 this year, records and numbers we haven't seen since the 80s. Yet we don't know some of those mystery buyers. Obviously, the theories are they are Russia and China.
Now China is non-transparent. Russia is much more transparent, although Russia is starting to be opaque a little bit because they're in a war. But you can see the inflection point is 2010. So from 1970 to 2010, it's a long stretch, 40 years, central banks were net sellers. It didn't mean everybody sold everything, but Switzerland's down 1,000 tons, US was down 1,000 tons after losing 8,000 tons, or sorry, 11,000 tons between 1950 and 1970. It was down, down, down. 2010 was the year that central banks became net buyers. Now, it doesn't mean every central bank was buying gold. It does mean that they were selling a lot less and others were buying more. And some of the buyers are Mexico, Kazakhstan, Philippines, Vietnam. We know China's a big buyer. We don't know exactly how much. Russia was a big buyer. That is continuing. Now the new players, Iran's non-transparent, but we know they're buying gold. Turkey is buying a lot of gold. Japan had a bunch of gold all along. They never told anybody about. Literally 1 month, their reserves went from 600 tons to 900 tons. Well, the market. You can't buy 300 tons in a month, not one country in one order. But they had it all along, but they decided to reveal it, put it on their balance sheet. So Americans don't seem to like gold. I'm not sure Canadians feel much differently, or others around the world. But central banks sure do, and I think that tells you something. There's huge demand for dollars all over the world, not because of the currency, but because of collateral, because of treasury bills. Banks need treasury bills to pledge as collateral for derivatives. It's the best collateral in the world. And if you don't have it, you're not going to be able to leverage your balance sheet as much as you would like. You're not going to be as profitable. You're not going to be able to support lending and investing, which is what banks in theory are supposed to do. To support the bloated balance sheets and to support the derivatives, you need collateral. And the better the collateral, the more leverage you can have. The best collateral in the world is a treasury bill. And so there's a mad scramble for treasury bills, which means there's a mad scramble for dollars to buy treasury bills. And that is coming from European banks, it's coming from Chinese banks, and banks around the world, but primarily European and Chinese. And that's not going away. So it's funny to hear people think it's funny to hear anyone talk about a dollar collateral shortage, like, hey, haven't you flooded the world with dollars? Hasn't the Fed printed $9 trillion? And the answer is they have. But that's not the measure. It's a high multiple of that. It's the dollar value of all the collateral. Because in the repo markets, I pledge the collateral to you, and then you pledge it to somebody else, one of our colleagues, and then she pledges it to somebody else, et cetera. That collateral gets pledged 50 times and supports not $1 a balance sheet, but $50 a balance sheet for $1 of collateral. And so you restrict the collateral, you're restricting the balance sheet. The dollar as a reserve currency will not be deposed overnight, but as a payment currency, there's a difference between a reserve currency and a payment currency. Anything can be a payment currency. If I want to pay you with baseball cards and bottle caps and you're okay with that, then it's a currency. So all of these organizations are working on new payment systems right now, and they're going to start to roll them out this year and later. So that's going to be a radical change in how we pay for things. I can give you 20 reasons why the dollar should go down, but I'll give you one big reason why it won't, which is the demand for collateral. And so that's keeping the dollar constant, which is keeping the dollar price of gold constant, because gold doesn't change and the dollar's not changing. Now that'll break, and that'll break in favor of gold, meaning the dollar will get a lot weaker. It'll have to, but it's going to take a few months at least, because the U.S. economy has to get weaker, which it is. The Fed will figure this out maybe by September, next September. And then they'll ease a little bit and they'll try to weaken the dollar to try to give the U.S. economy a boost. But we're not there yet. So it's going to be, now that doesn't mean the price of gold is going down a lot. I'm just saying it's not going to go up a lot. It's going to chug along kind of sideways. But when it breaks, it's going to break big to the upside, because the dollar is going to go to the downside. But that's probably at least still a few months away, maybe longer.